How do long-term capital gains impact you? Tax is something that we pay when we generate any kind of income or profit. In the same way, profits from asset sales are also taxed. Taxes apply to all gains you make from assets like mutual fund units, shares, real estate, gold, and artwork. For those not versed with this, there are two kinds of taxes that are levied on capital gains: long-term capital gains and short-term capital gains. Today we will take you through long-term capital gains and its implications on your finances. To begin with, let's take a look at what long-term capital gains tax or LTCG is. Long-term capital gains tax is a tax that you pay for gains earned on assets you hold for the long term. Stocks and equity-oriented mutual funds held for more than a year are subject to long-term capital gains tax. This tax of 10% is levied if there is any profit of more than rupees 1 lakh for more than 1 year from equity investments. For debt mutual funds, a holding period of more than 3 years is considered long-term. No matter what tax bracket you fall into, you will have to pay 20% of long-term capital gains tax on debt mutual funds after indexation. You can reduce your tax liability by indexing the cost of debt mutual fund units to the prevailing inflation rate. Now let's see where the long-term capital gains tax is levied. Number 1. On real estate and land holdings that are held for more than 2 years. 20% of long-term capital gains tax is levied after indexation. Number 2. Long-term capital gains tax on gold is 20% after indexation. For gold to be considered a long-term holding, it must be owned for at least 3 years before being sold. Number 3. Long-term capital gains tax is levied on other movable assets such as paintings, art, and even cars if held for more than 3 years, and the rate is 20% after indexation. Finances are always affected by taxation. Let's look at the implications of long-term capital gains on finances. This tax can impact you if you sell any capital asset and earn a profit on those. You are exempt from taxes if you receive an inheritance. Inheriting property, gold, or any other capital asset from a relative does not require you to pay tax. However, selling inherited assets does require you to pay long-term capital gains tax. It is possible to avoid this tax to save on your finances. For long-term capital gains on the sale of property, land, or any other immovable asset, you can reinvest the gains in another immovable property or certain government bonds. To avoid tax on the sale of other assets, you can reinvest the entire amount in property. But you cannot invest only the gains. You need to reinvest the entire sale amount. I hope you enjoyed this video and you learned all about long-term capital gains tax and its different kinds. Remember, long-term capital gains tax can be very significant to your finances, so do apply all the learnings from this video.
Investments in securities market are subject to market risks. Read all related documents carefully before investing.